Imagine waking up one day as a millionaire, all thanks to a few smart real estate investments. Sounds like a dream, right? For years, we've been told that real estate is the golden ticket to wealth. But here's the million-dollar question. Is it really as easy as buying a few properties and watching the money roll in? Or is there more to this story that no one's telling you? Buckle up, because we're about to reveal the shocking truth about real estate investing that could change your financial future forever. The reality of buying real estate. While the idea of buying an apartment, renting it out, and earning a stable income sounds like a dream, the reality is much different. Real estate prices are continuously rising, especially in major cities, making it difficult for the average person to afford property. In Europe, for example, the cost per square meter in popular areas can be several $1,000s. A small 40-50 square meter apartment can easily set you back $200,000 or more. And let's not forget that it's not just the purchase price. There are closing costs, renovation expenses, property taxes, and maintenance fees. For many, the only way to afford such an expensive purchase is through a mortgage. But even getting a mortgage requires a significant down payment, often 20% of the property's price, and a mountain of paperwork. Not everyone can afford or qualify for that. And that's just for a single property. How can you invest in real estate with $100? This brings up an important question. Is it possible to invest in real estate if you only have $100? The good news is, yes, it is possible. There are a few investment options available today that don't require huge amounts of capital to get started. In this guide, we'll explore 3 of the best options: REITs, real estate investment trusts, crowdfunding, and ETFs, exchange-traded funds. These might sound complicated, but by the end of this article, you'll have a clear understanding of how they work and how you can start investing with minimal capital. What are REITs? Buying real estate the traditional way requires a significant amount of money up front. You have to either pay in full or get a mortgage, and even if you manage that, you still have to handle the property, find tenants, and maintain it. Real estate also typically has a slow return on investment, ROI, meaning it could be years before you start seeing significant profits. But what if you could invest in real estate without having to own or manage a physical property? This is where REITs come in. REITs. Simplified in simple terms, REITs, real estate investment trusts, are companies that pool money from investors to purchase and manage income-generating real estate. This can include anything from apartment buildings to shopping malls, offices, and even hotels. These properties are rented out, and the income generated is shared among the investors. Instead of directly owning a property, you own shares in a REIT, and the REIT owns the properties. REITs allow you to invest in real estate much like buying shares of a company. You don't need to deal with tenants, repairs, or other property management tasks, but you still benefit from the income generated by the properties the REIT manages. How do REITs make money? Most REITs follow a simple business model. They buy or develop real estate, rent it out, and then share the rental income with their investors in the form of dividends. Dividends are essentially your share of the profits, and they can be paid monthly, quarterly, or annually. There are 2 main ways you can make money from investing in REITs. 1. Dividends. The REIT pays out a portion of its profits to shareholders. 1. This is often a passive income source, meaning you don't need to actively manage your investment. You buy shares in a REIT, and over time you get paid dividends automatically. 2. Capital appreciation. If the value of the REIT's shares increases, you can sell your shares at a profit. For example, you might buy REIT shares at $20 and later sell them for $40, doubling your investment. Which is better, dividends or capital appreciation? It depends on your financial goals. Dividends provide regular income, making REITs a great option for those seeking passive income. Meanwhile, capital appreciation can lead to significant profits, but it requires a bit more active monitoring of market trends. An example of how REITs work. Imagine you bought shares in a REIT that focuses on residential apartments for $25 per share. Over time, the REIT earns rental income from these apartments, and you receive quarterly dividend payments. Let's say the dividend yield is 5%, meaning you get 5% of your initial investment every year. Now, let's assume that after a year, the price of the REIT shares goes up to $35. At this point, you can either sell the shares for a profit or hold on to them and continue receiving dividends. Benefits of REITs. 1. Low initial investment. you don't need a lot of capital to get started. With as little as $100, you can start investing in REITs. 2. Diversification. REITs allow you to invest in various types of real estate, from residential to commercial properties, without having to buy individual properties yourself. 3. Liquidity. Unlike physical real estate, REIT shares can be easily bought or sold on the stock exchange. If you need access to your money, you can sell your shares quickly. 4. Regular income. Dividends provide a stable source of income. Drawbacks of REITs. 1. Limited growth potential. Public REITs are required to pay out most of their profits to investors, leaving less money for reinvestment and growth. 2. No control over properties. Unlike owning a rental property, you don't have control over which properties the REIT invests in or how they are managed. 3. Scams. Be cautious of fraudulent REITs. 3. Always do your research before investing. Crowdfunding as a real estate investment option. Another option for investing in real estate without a large amount of money is crowdfunding. Crowdfunding allows you to pool your money with other investors to buy property. Think of it like joining a book club, but instead of reading books, you're investing in real estate projects. How does crowdfunding work? Through real estate crowdfunding platforms, you can invest in properties that you otherwise wouldn't be able to afford on your own. The platform collects investments from many individuals, and together, they purchase the property. You then own a portion of that property, and any rental income or profits from a future sale are distributed to the investors. Example of crowdfunding. Let's say you and a group of friends decide to invest in a luxury apartment in Dubai. You each contribute $1,000 through a crowdfunding platform. The platform purchases the apartment, and any rental income or profits from selling the apartment are shared among the investors. Advantages of crowdfunding. 1. Low entry. Minimum. Crowdfunding allows you to invest in high-value real estate with a small amount of money. 2. Control over investment choices. You can choose the specific property you want to invest in. 3. No property management. The platform handles all the day-to-day management of the property, so you don't have to worry about finding tenants or repairs. Disadvantages of crowdfunding. 1. Risk of fraud. Not all crowdfunding platforms are reputable, so it's crucial to do thorough research before investing. 2. Lack of liquidity. Unlike REITs, you can't easily sell your share in a crowdfunding project. You may have to wait for the property to be sold or refinanced before you get your money back. Real estate ETFs. Another path to real estate investment. Another option for real estate investment without buying physical property is through ETFs, exchange-traded funds. A real estate ETF is a fund that owns a collection of REITs or companies involved in real estate. This allows you to spread your investment across many properties and companies without needing a large amount of capital. Benefits of real estate ETFs. 1. Diversification. ETFs give you exposure to a wide range of properties and real estate companies, spreading out your risk. 2. Liquidity. Like REITs, ETFs can be bought and sold on the stock market, providing easy access to your investment. 3. Regular income. Many ETFs pay dividends, offering a steady source of passive income. Drawbacks of ETFs. No ownership. As with REITs, you don't own the properties directly, and you have no say in how they are managed. Conclusion: you don't need hundreds of thousands of dollars to start investing in real estate. Through options like REITs, crowdfunding, and ETFs, anyone can get started with minimal capital. Each method has its pros and cons, and the best option for you will depend on your financial goals, risk tolerance, and how hands-on you want to be. Whether you're looking for regular passive income or long-term capital gains, there's an investment strategy that can work for you. So, don't let the high prices of traditional real estate scare you away. Start small and grow your wealth one step at a time. Now that you've learned about these accessible real estate investment options, it's time to take action. Don't let this valuable information go to waste. Here's what you can do next. 1. Research further. Dive deeper into REITs, crowdfunding platforms, and real estate ETFs. 1. Knowledge is power in the world of investing. 2. Start small. Remember, you can begin with as little as $100. 2. Choose one of the methods we've discussed and take that first step. 3. Diversify. Consider spreading your investment across different options to minimize risk. 4. Seek advice. If you're unsure, consult with a financial advisor who can guide you based on your specific situation. The journey to financial freedom through real estate investing starts with a single step. Don't wait for the perfect moment. The best time to start is now. Your future self will thank you for the decision you make today. If you found this video helpful, please like, share, and subscribe for more content on smart investing strategies. Drop your questions or experiences in the comments below. Let's learn from each other and grow together.